It is a Tuesday morning. Jade, 42, Marketing Manager, Tampines. She is sitting in the oncologist's office at Singapore General Hospital. Her husband is next to her. The doctor explains the diagnosis. Breast cancer. Stage 2. Highly treatable. Caught early. The survival rate at this stage is excellent. Jade is not thinking about survival rates. She is thinking about Thursday. That is when the mortgage payment goes out. $2,400 every month, whether she works or not. She has MediShield Life. She has an integrated shield plan from her employer. She has spent 20 years thinking she is covered. She does not yet know the difference between a bill that is covered and a life that is not. That gap, the one between the medical bill and everything else, is what this video is about. 1 in 4 Singaporeans will develop cancer by age 75. 44 people are diagnosed every single day. 17 die from it every day. Cancer is the leading cause of death in Singapore, responsible for roughly 26% of all deaths. And yet, according to the Life Insurance Association's Protection Gap study, 2 in 3 Singaporeans have no critical illness coverage at all. Those who do have it are, on average, 74% underinsured. That is not a headline number. That is a number that decides what happens to your family in the months after the diagnosis. Here is what happens financially when cancer arrives. Not in theory, in sequence. Day 1, the diagnosis. Jade's first call after leaving the hospital is not to her insurance agent. It is to her mother, then to her sister, then to her husband's HR department to understand if she can take medical leave. Cancer treatment does not happen over a long weekend. Surgery, followed by 6 cycles of chemotherapy, followed by radiation therapy. In Jade's case, this is an 8 to 12-month process. Day 7. The first bills start arriving. A PET-CT scan to stage the cancer properly. $2,310 to $3,600, partially covered. A biopsy, between $2,400 and $6,200, depending on complexity. These diagnostic costs come before treatment begins. Her integrated shield plan covers the hospitalization. What it does not cover is the deductible. Since April 2026, new IP rider rules require every patient to pay the first $1,500 to $3,500 out of pocket before insurance touches the bill. That change happened this year. Most Singaporeans who bought their IP 5 years ago do not know about it. Month 2. Surgery. A mastectomy at a public hospital in a subsidized ward. The total bill, $28,000. After MediShield Life and IP, Jade pays $3,500 deductible plus co-payment of approximately $2,800. $6,300 out of pocket from one procedure. Month 3 through month 8. 6 cycles of chemotherapy. CDL drugs covered within MediShield Life and IP claim limits, but supportive care drugs, scans every 2 cycles, anti-nausea medication, these sit in a separate MediSave category capped at $600 a year. Whatever exceeds that, cash. Then radiation therapy, $25,000 to $30,000 full course, approximately $5,000 remaining after insurance. Total medical out-of-pocket, roughly $15,000 to $18,000. With full MediShield Life and a solid IP. Now the second bill, the one insurance does not touch. Jade stops working in month 2. She is too fatigued from chemotherapy to manage her team. Her employer is supportive. She goes on unpaid medical leave after exhausting her paid leave entitlement. Her salary was 6,200 Singapore dollars a month. After CPF contributions, she took home 5,014. Every month she is not working, that disappears. The mortgage does not disappear. The 2 children's school fees do not disappear. The utilities, the groceries, the transport, none of it disappears. Month 3 through month 8, 6 months of lost income. $5,014 per month times 6 months. That is $30,084 of vanished household income, before a single medical bill. And during those 8 months, Jade's CPF contributions stop. No employer contributions, no employee contributions. That pause in CPF accumulation cannot be recovered simply by returning to work. The compounding that did not happen in those months is gone. Her husband earns $4,800 a month. The family was structured around 2 incomes. With one gone, they are covering a 2-income mortgage, 2-income lifestyle, on 1 income plus whatever savings they have. On top of lost income, a part-time helper at $1,600 a month during treatment, transport to SGH 3 times a week, dietary supplements. Over 8 months, another $12,000 to $14,000. Total financial impact of Jade's early-stage breast cancer, approximately $60,000. Early stage, excellent prognosis, $60,000. She had $45,000 in savings. What Jade needed was not a better hospitalization plan. She had one. What she needed was critical illness insurance that paid a lump sum the day she was diagnosed, before the bills, before the lost income, before the helper, before the transport. Money she controlled. Money she could use however the situation required. The Life Insurance Association recommends 3.9 times your annual income in critical illness coverage. For Jade on $6,200 a month, that is 3.9 times $74,400, $290,160. The average critical illness claim payout in Singapore is $52,343. For Jade, that is less than 1 year of income. The LIA says she needs almost 4 years. The gap, $237,800. Not because CI insurance is unavailable, because the amount most Singaporeans buy, if they buy at all, is chosen by inertia, not by calculation. Tonight, Jade opens a browser and does 2 things. She checks the CPF health insurance planner under SingPass. It shows her existing coverage and the estimated gap based on her income and age. Then she searches Critical Illness Insurance Singapore 2026 and calls one financial advisor the next morning. The cost of a term CI plan for a healthy 42-year-old before a diagnosis is a fraction of the cost after. That call costs her nothing. Not making that call already cost her $60,000. Now move to someone different. Marcus, 38, IT project manager, Ang Mo Kio. Wife, 2 children, ages 9 and 5. HDB mortgage, $2,400 a month. Total household income, $9,600. Marcus was diagnosed 8 months ago with colorectal cancer, stage 3. He had critical illness insurance, 100,000 Singapore dollars. He bought it 6 years ago when his company offered a group plan. It seemed like enough. Here is how $100,000 disappears in a cancer recovery. Day 1 of diagnosis. CI payout arrives within 2 weeks. $100,000. He feels covered. Month 1. Pays off accumulated medical out-of-pocket costs from diagnosis and initial treatment. Approximately $12,000. Month 2 through month 14. Cannot work. Stage 3 colorectal cancer requires surgery, 6 months of chemotherapy, and extended recovery. His wife reduces to part-time. Household income drops from $9,600 to $3,200. Monthly shortfall, approximately $4,500. Over 14 months, $63,000. 100,000 CI payout minus 12,000 medical costs minus 63,000 income gap, 25,000 remaining after 14 months. 3 months after returning to work, the oncologist orders a follow-up PET-CT. A suspicious node. Watchful waiting. More scans every 3 months. The financial anxiety of not knowing is not covered by any insurance product. What Marcus needed was $250,000 in CI coverage, close to the LIA recommendation for his household income. What he had was $100,000, bought at a time when it seemed like a lot of money. What he does differently now: he reviews his CI coverage the week he returns to work. He calls the insurer to increase the sum assured. His health has stabilized. The policy is still active. He increases from $100,000 to $200,000. The additional premium on a term plan, approximately 350 to 400 Singapore dollars a month. He finds that by cutting one discretionary expense, the monthly family restaurant dinner, and redirecting it, the coverage gap closes. Not perfectly, but substantially. Now the third person, and this one is the most common. Priya, 35, freelance graphic designer, Jurong East. No employer, no group insurance, no CI plan. She was diagnosed last year with early-stage lung cancer, stage 1, caught through a health screening she almost skipped. 5-year survival rate at stage 1, close to 90%. Treatable. The medicine worked. What did not work was her finances. As a self-employed person, Priya has no salary continuance, no employer medical benefits, no group critical illness plan. She has MediShield Life, mandatory, and that is it. No integrated shield plan, no CI coverage. Treatment at a subsidized ward, Ward B2. Her MediShield Life covered the majority of the hospitalization. Out of pocket, approximately $8,000 to $12,000. Manageable. What was not manageable, 9 months without income. A freelancer without income is not on medical leave. A freelancer without income has no income. Her savings, $30,000. At month 6, they were gone. She borrowed $22,000 from her parents. She is still repaying it. Here is the number that matters most for Priya specifically. As a self-employed person, Priya's MediSave contributions are based on her declared net trade income, not automatically deducted like an employee. Of all self-employed persons in Singapore, approximately 25% are not fully current on MediSave contributions, according to a parliamentary answer from February 2025. During illness, when income stops, MediSave contributions stop too, which means the healthcare safety net that employees take for granted does not automatically apply. What Priya does in the month after she is cleared for work? She buys a term critical illness plan. As a 35-year-old non-smoker in good health post-treatment, most insurers will cover her with standard exclusions for the treated lung cancer, but full coverage for all other conditions. The premium for a $200,000 term CI plan to age 65? Approximately $300 to $450 a month. She treats it as a fixed business cost. It is cheaper than losing another 9 months of income. She also sets up a gyro for MediSave top-ups, $200 a month voluntary on top of her mandatory contributions. This rebuilds the healthcare buffer that the illness depleted. 3 people, 3 different income levels, 3 different levels of preparation, 1 shared reality. The medical system in Singapore works. The bills are paid. The survival rates are real. The cancer, in all 3 cases, was treated. What the medical system does not cover is the life around the illness. Here is the clearest way to understand this. MediShield Life and integrated shield plans are designed to pay the hospital. Critical illness insurance is designed to pay you. When the hospital bill arrives, IP handles it. When the mortgage arrives and you cannot work, only CI handles that. Most Singaporeans conflate the two. They think a good IP means they are covered. They are not. They are covered for the bill. They are not covered for the life. One thing every working Singaporean should know before a diagnosis. Standard CI pays out at late-stage cancer, stage 3 or 4. Early CI pays at stage 1 or stage 2, including carcinoma in situ. 5-year survival at stage 1 lung cancer, close to 90%. The treatment is less intensive. You need income replacement for 3 to 6 months, not 14. Early CI costs roughly 20 to 40% more in premiums. Against the gap it closes, that difference disappears. If you are self-employed, treat CI insurance as a fixed business operating cost. There is no employer to catch you, no group plan, no salary continuance. The only buffer is the one you build. Jade is back at work. 11 months after the diagnosis, she returned part-time in month 10 and full-time in month 12. The cancer is in remission. The follow-up scans are clear. She sits in the same oncologist's office for her 6-month check. This time, she is not thinking about Thursday's mortgage payment. The CI insurance she bought 3 weeks after returning to work, $250,000, termed to 65, is active. The premium is $390 a month. She thinks of it differently now. She calls it the second salary, the one that would pay even if she cannot. What is your number? Not what feels like enough. What the calculation actually says, 3.9 times your annual income minus whatever CI coverage you currently have. If you have never done that calculation, do it tonight. CPF Health Insurance Planner. SingPass, 7 minutes. Cancer does not wait for you to be ready. The insurance has to be in place before the call from the oncologist, not after. And if this video changed how you think about the gap between your hospital plan and your actual financial protection, the next one is about how to build the right coverage stack without overpaying. Subscribe so you do not miss it.